You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, get centered here. Happy Tuesday. Hope you're doing well. Hope you guys had an awesome Labor Day weekend. We are back with Masters in Trading Live. I get on here every day the market's open, 11 o'clock Eastern time, to go over the market, share some thoughts, and once in a while, we'll even share our trade of the day. What topics are we getting into today? Today we're going to talk about the week ahead. We have Friday non-farm payroll. That is a catalyst for movement. I want to talk about how to scan for option trades. What do we need to look for? How can we get close to finding a group of stocks that we either want to get long or potentially get short? And then finally, I got a little trade idea, I got a trade idea at the end of this that I'm excited to share. By the way, if you guys are watching on YouTube, at any time, if you guys have any questions, you can throw those questions. We'll make sure we get back to every one of those questions. Figured I'd have to throw that in there. Let's go to the slides. Okie dokie. Now, Masters in Trading Live, we talk about VIX term structure. VIX term structure is volatility looking at 9 days, 23 days, 30 days, 37 days, 90 days, 180 days, 365 days. Oh, that's 1 day. 365 days. And then the VIX 1 day, that is just volatility for 1 day. Volatility is high. We have, well, first of all, it's extremely flat as well. What does that mean? Glad you asked. If we look at VIX term structure, it's 18. Whoa. A little fire alarm. I don't know if you guys can hear that. My area's got a little fire warning going off. Hope everyone's safe. VIX term structure is 18. We go out a little further, it gets to 19. We go out a little further, it gets to 20. We go out a little further, it gets to 21 for 1 year. It's extremely elevated. It's very, very bearish. If the VIX term structure, especially in these first 30 days, stays up here, okay? Very, very, very bearish. But for the market to really move, we need a catalyst, okay? The market doesn't just move because it wants to move. It moves because it has a reason to move. One of those reasons for movement comes 12 times a year, and it comes on the first Friday of every single trading month. It's non-farm payroll. And Friday, we have the unemployment report. It'll be released 7:30 Central Time. Forecast 200K, expected to be 4%. Either way, guys, this is a mover. So we want to look ahead and expect that we're going to see more movement throughout the week. That makes me very skeptical of big moves before unemployment. But with that being said, I'm skeptical of big moves before unemployment. But what makes me not skeptical is when we see follow through in the front end of VIX term structure. So VIX 90, you can just plug it in, VIX 90. Now it doesn't have options. That's why I can't use my VolViz on this thing. But VIX 90, if it stays above 17, we are going down. Use 17. After 17, I'll ask you to use 15. But as long as the VIX 90 stays bid above 17, market is going to go down. Keep it simple, okay? I'll call this common sense trading. Let's press on. This is an important topic and one that, first of all, people don't teach, people aren't familiar with, and it concerns me. So let's talk about strikes in options. And I have two examples here. GDXJ is a $46 stock. The 4Us is a $5 stock. Okay? Now, I am a huge proponent that any options that are trading under 10 are extremely difficult to trade, especially for those who don't have a ton of options experience. We prefer to trade options that are a little bit higher priced, and I'm going to show you exactly why. And it's really freaking important. 4Us as trading $4.90. The strikes, it has strikes of 4, 5, 6, right? Look at the strikes on this $5 stock. GDXJ, okay, if you guys want to know, this is a little uranium stock, and this is a gold miner, little gold miners. GDXJ, look at the strikes, guys. 42, 42.50, 43, 43.50, 44, 44.50. This is a big deal because what's the percentage impact? Listen, the 4Us, the strikes, guys, are 20% apart. 20% apart. Because the stock is a $5 stock. GDXJ, all of these strikes, guys, are about 1.1% apart. Where is the advantage? If a stock is trading 100 at 101, a bid and an offer, that might be a good trade, right? You could buy at 101 or you could sell at 100. What happens if it's 100 at 120? Would you buy at 120 and sell at 100? Or would you say, no, thank you. That's not fair. I'm not going to play in that game. I'm guessing it's the latter, right? Well, for that reason, you do not want to trade options on stocks that are trading less than $10 because most often the strikes are going to be so wide. I think it's really important to note, and I'm going to erase a little bit of this, but think about this. What's the difference between a $5 stock and a $50 stock? Which company is worth more, the $5 stock or the $50 stock? Well, you know what? They could be exactly the same. They could each have a $10 billion market cap because all you need is a little financial engineering and a 1/10 stock split to have this sucker trading $5 or a 10 times stock split and have this guy trading $50. It's all financial engineering. It's the same reason why when a stock trades 1,000, they cut it back down to 100, so therefore retail can participate or funds can participate. Watch out for this. This is really important, and I think it's a sucker's play that steals a lot of good people's money. Let's move on. Let's talk about search. Let's talk about what we're looking for when we're looking for trades. So at Masters in Trading, because I was a market maker on the floor of the Chicago Board Options Exchange, that's where I learned to follow unusual options activity. Before I was a market maker, I thought I understood options. But then I got down on the floor and I realized that I didn't know bupkis. And then I learned that all the traders on the floor were just staring up, looking at the screens, waiting for the biggest orders in the room. They were waiting to see where the smart money was flowing towards. After they found trades that had gnarly, unusual options activity, then they would determine if that trade was expensive or inexpensive. Next, patience. What level are you willing to pay to get into that trade? You control your trading account. The market doesn't control your trading account. If you want to get long stock ABC, you figure out what you're comfortable paying and then work in order to get filled at that level. It doesn't matter what the market's at. You want to figure out what you're comfortable paying, and then we want to make sure that volatility is good. Make sure our volatility is okay. How can we do that? Well, we could check historical volatility relative to implied volatility. So here's a scan that I use just to give you guys an example. We'll use what I call our high value target tool to determine if a stock is expensive or inexpensive. We had this QQQ trade where it was inexpensive, and then we got a really strong move up until the upper band. What this uses is a 21-day moving average of historical volatility. So let's run a scan. And what I did is I just got in, I'm using Thinkorswim, and I'm using a scan using our high value target. And what I'm looking for is I'm looking for a buy signal. This green guy is a buy signal. I'm looking for a buy signal within 2 bars. Within 2 bars is 2 daily closes. I'm looking at all optionable. I'm looking at all symbols. Now, we ended up coming out with 10. But what I'm also doing is, notice in my scans, I want a minimum of $7 because I don't want any high price stocks. Also, in this scan, I put a minimum of 440 million market cap. Why? I'm looking to get the subset down of names that we're looking at. And so then once I find 10, this is a manageable number. What else, when I'm scanning for a trade, am I looking for? Market cap, I already told you, I explained why. Above 500, so there's liquidity. Beta, what is beta? Beta is systematic risk. Systematic risk is risk to the system. So if the S&Ps fell 10%, DRD would fall twice as much because of that SPX fall than West, because the beta is 1 and the beta of West is just 50. So the higher beta that you have, the more volatility that you could expect. Historical volatility versus implied volatility. Implied volatility is how the market is pricing stocks right now. Historical is how it priced them in the past. What's interesting to me is look at this. BZ has the highest beta. I guess OMAB has a high beta as well. BZ has a $5.5 million market cap. Historical volatility over 1.06, but implied volatility is just 49. That's an interesting trade to me. What I also did is I took this same scan and I looked in real estate because the Fed is going to lower rates. What sectors do the best when the Fed lowers rates aggressively? Well, REITs do really well. Biotechs do really well because the cost of capital goes down. What I want you to notice is I ran this same scan, not just looking for 2 bars like we've done looking for trades, looking at 8 bars. In the last 8 days, can we find any buy signals in REITs? No, we cannot. Why? Because the sector is already strengthening up. Let's do the same thing in biotech. Can we find anything? The only names that we can find in biotech that have had any kind of activity, buy signals in the 8 days, is SLN and ARWR. Also, please realize these are 8 days ago. They've already received. I just want to show you how those sectors are strengthening up. Let's get back to the main scan because I do like this name BZ. BZ is interesting to me. Here are two different charts. This chart we call our vol visualizer, and this is showing us just volatility, how volatility is priced every month. BZ closes within those bands 80% of the time. Right now, BZ is outside of those bands, so we would expect it to rally up. Also, BZ, you noticed on our scan, right? We had the buy signal. Well, there she is. So BZ, we have low vol, we have a high beta relative to the others, and we have buy signals, right? It's a good time to buy. So BZ, and I'll throw a trade out there for everybody that we'll put in our promotional portfolio. In BZ, I just want to pull up the actual option chain in case she's made a big move since I've taken this screenshot. So BZ, right here, look at that. She's on sale from when I did this just a little bit ago. October, again, look at these. These are great. Really, really just good markets. 60 cents. Let's buy 12 pluses for 60 cents. Nice little market. Vol's not too high. It's got my three favorite letters, ADR, American Depository Receipt. Why do I love these three letters? Because it just tells me who the heck knows where this thing is valued at. BZ, we're going to be looking at the 12.5 buy to open. 12.5 buy to open October for 60 cents. And we have 45 days until expiration. What do you think? That trade look good? It's kind of cool when you go and you start scanning and then you start to think like, okay, if rates come down sharply, like most likely when rates move, they move quickly. When rates move down sharply, what sectors are going to do well? That's a great question that you can go ask ChatGPT. Historically, when rates have moved down quickly and when the Fed takes rates over the course of a year or 2 years, what sectors outperform? REITs is one, biotechs is another. Go find some, and those are the names that you want to find inexpensive trades to get long. Everybody in our All Access, you guys don't go anywhere. We're going to talk about our portfolio.